Welcome to the Investing Show. I'm Simon Lambert of This Is Money. Joining me in the studio, I've got Ben Kumar of Seven Investment Management and Richard Hunter of Wilson King Investment Management. Now, 30 years ago, there was rather a large event, and it wasn't just a bit windy. It was Black Monday. Now, since then, we've had a number of booms and crashes since. We've had the tech boom, we had the 2000s credit boom, and then the financial crisis. And there are some people who would suggest that we are due another crash. Who knows when that will arrive. But looking back at Black Monday, I think it's interesting to see what happened and have we learned anything from it. So, Ben, coming over to you first. Black Monday, what happened on that day?
So I wasn't actually alive on that day, so it's a little tough for me to paint you an exact picture.
So you can't remember?
No, well, I think that's unfair. So when you see a market crash down 20% in the United States, obviously it has this ripple effect around the world, right? Okay, the internet wasn't really a thing, and we didn't have quite the same level of interconnectedness. But when the stock index falls, regardless of whether it's before World War I, before World War II, or 1987, things happen, people panic, and if they sell and you see someone else selling, it creates this vicious circle. And we're still subject to that today, I would think.
Richard, was it the sheer magnitude of the fall on Black Monday that makes it stand out so much?
Yeah, it was. Unfortunately, I have to admit that I had started in stockbroking, so I was alive.
It wasn't your fault, though?
Not knowingly. No one's come up to me yet, but I started in '86, so within the first 18 months I'd had Big Bang, and then the stock market crash, so that's a good way to learn. But we hadn't had anything like that in the preceding, probably since the mid-1970s and the problems we had with oil and all the rest of it. But it was just extraordinary. I think that's one of the places that the phrase, in terms of sellers pushing against an open door, came from. Again, it's difficult to picture, but there was virtually no automation at the time. So any orders you'd be taken from clients were on pieces of paper. And I remember to this day that the sale orders, the yellow slips, being piled to the ceiling, and the blue slips, the buy orders, you could probably get down to that sort of amount. And that was just a good indication of the kind of panic that you had. I think these days, although we will have corrections and crashes, of course we will, as time goes forward, but one advantage we've got these days is that communication via social media, news outlets, is so much quicker and real time, as opposed to a lot of this stuff was being done on the telephone in those days. As Ben rightly says, the internet wasn't really there at all.
Looking at some figures that you guys at Seven have run here, we've got October the 19th, that was the day of Black Monday. What happened to the market on that day? FTSE 100 down 10.8%, the S&P 500 down 20.5%, the FTSE 250 was down 8.8%, Euro Stoxx 50 7.9%, the Topix in Japan was only down 2.4%, but gold actually rose slightly at 2.2%. But it's really when you look at the returns over October and November that it becomes quite so astonishing. Over those 2 months, the FTSE lost a third of its value, which is amazing, really, to consider quite how quickly it fell by so much. Especially when you then go and look at the financial crisis, for example, where we had, after the tech boom, we had the FTSE was down around 42%, but that was over a period of 3 years, March 2000 to March 2003, and the financial crisis saw the FTSE lose about 40%, but again that was between October 2007, March 2009. I mean, is it that one of the things behind the whole Black Monday thing, where you try to go into it and look, why did this happen? There's no real one reason why it happened. Markets had been doing well, valuations were a bit punchy, there'd been a bit of the introduction of programmatic trading, which was meant to have exacerbated this, and it was a freak occurrence. Whereas if you look at the tech boom or the financial crisis, those big falls were much more long and drawn out and more painful over that long period of time. Because it took much longer for the markets to rise back up. But they were actually caused by an identifiable problem. Do you think that has an important bearing on how we react to these things?
Yeah, I think it does. So one analogy I've been thinking about recently is, Black Monday was like the flash crashes we've seen where program trading goes out of control and a market crashes 20% in the space of a second and then it's back up again. It's like that, but slowed down a little bit, right, because of the lack of program trading going on back then. Whereas, as you say, global financial crisis, tech boom and then bust, those were fundamental underlying reasons for those events. I kind of think that the Black Monday example and the 2 months following it is, although incredibly painful, a slightly better occurrence and maybe a little bit more analogous to today. So there's not really a catalyst for things going wrong today, and people are obviously drawing these comparisons. Valuations are a bit high. I would have thought that if you see a Black Monday style event today, it's going to be even briefer, right? Maybe a couple of days before markets bounce back. And that's because you've got circuit breakers now, which are really important. So the market stops trading at 7% down for 15 minutes and then 10% down for half an hour, and then if it falls again by 3% for the rest of the day, you're done. It will open the next day, and then the program traders can run that again. We saw it in China at the start of 2016. The exact same thing happened 2 days in a row. The market was shut after the first half hour of trading. But then the markets rallied again. People don't talk about the Black Monday in China at the start of 2016. It's just a one-off event, slightly exacerbated, and then reality reasserts itself. People find the buying opportunity perhaps a lot quicker. The blue slips analogy you used is an interesting one. Those blue slips come onto the plate a lot sooner nowadays.
Yeah, you're right. And the other interesting thing to bear in mind, and I don't know if you remember, quite a few shows ago we had that graph of the FTSE All Share since the Second World War and the inexorable growth up to the present day. The 1987 crash was a tiny little V, which we highlighted over there. So, again, cataclysmic though it seemed at the time, in the overall scheme of things, it turns out to be just a good shakeout.
And the market actually didn't end up down that year, did it? I think it ended up over the course of 1987. So, it does show that it maybe was a bit of an anomaly. But going back to the bigger bubbles that we've seen, the bigger booms and busts, is it the case that when you look at those and you see this big build-up, for example, the tech boom or the build-up to the financial crisis, that the stock markets tend to start to get dominated by a certain type of company, and that tends to be the type of company that's leading the boom, and you would therefore presume is more at risk from the bust?
Yeah, I think that's fair. I mean, it's partly as well kind of people start playing in the market who haven't really been there before, right? If you think about going back through history, the tulip boom, bust, whatever, the South Sea Company, it's when the man in the street, right? That if you're getting your tips from the shoe shine boy or the taxi man, you need to start thinking about exiting the market. That's something we saw in the run-up 2007, 2008. Okay, it happened in the housing market a little bit more than the equity market, but suddenly you had people who, usually wouldn't be investing. Risk of a panic increases. And what do they invest in? Well, they invest in things that are popular. So back in 2015, in China, there were reports of people, selling food on the side of the streets who were saying, once the Shanghai index gets above 3,000, it's a definite buy. That was a bubble there. It rose 150% and crashed. And where was it invested? Well, in China it was anything, because all stocks have basically just been made available for investment. Over here, now, in the developed world, you've got to look at the tech industry, but I think you've got to look at particular niches as well. Cryptocurrencies are being talked about a lot nowadays. You're starting to hear whispers of syndicates of postmen in Kent investing in cryptocurrencies. Maybe a little bit of warning that there's something in some parts of the tech sector that are worrying.
I think in terms of the dot-com bubble, the FTSE 100 at the time that the bubble burst had 10 technology companies, or TMT companies as they were called at the time. And a lot of the things that were coming through, there are slight echoes today, in as much as some really punchy valuations of certain tech stocks, not all of them, but certain ones. But of course, in the late 90s, as technology was really starting to take a hold, a lot of these companies that are being quoted on both sides of the pond hadn't made a penny in revenue, let alone profits. And yet they were on these excessive valuations. So that one is almost easily explained, and you could probably, there was a sort of 6 month run up to the dot-com bubble bursting where it would have been difficult not to have made money in anything, but it was pretty clear it was coming in quickly. Whereas today, with those few exceptions that I mentioned, I think that there's a lot more focus on valuations and projected earnings than there probably was.
We're talking about it more, right? Yeah. And the fact that Amazon and Facebook, Google, people mention them, say, are they on too higher valuation. Well, at least they have some earnings, right? You know what their business model is. They aren't just saying, yeah, I've got a new website and we're going to tell you that clicks per person is a good metric to measure by. They're saying, yeah, I bring in billions a year and I may be valued at hundreds of billions, but you can see where the growth plan is. So we're slightly more cognizant, I think, of this exactly the same thing happening again. But yeah, there are little echoes. I think my kind of thing to watch at the moment is things like Snap going public with non-voting shares. Yeah. That hasn't gone very well. Things like Blue Apron over in the US. Pitched as a tech company, actually it just delivers vegetables to people's offices. That's not gone very well either. You know, little areas like that where maybe people are selling you something that's not quite what their real business is.
Or that kind of like change the world scenario. So you've got tech companies, and you've got tech companies that are making plenty of money, and then you've got this is going to completely change this industry. And then it gets picked up on, the ball starts rolling, and then you realise that actually that company would have to not only completely change its industry, but entirely dominate its industry to perhaps a unimaginable extent in order to justify the valuation. We have that in this country with Purple Bricks, for example, which is a great company and has become the first of the online estate agents to really get its name known. But the valuation on it is absolutely sky high. It's a £1 billion company with, I think, revenue of maybe £50 million a year or something like that. So if you look at a scenario where you think there's too many of those companies in an index, and as an investor, what can you do about it? Obviously, we've seen now a lot more people move towards passive investing, towards index funds, and those index funds are presumably going to be the ones that are most exposed to the big chunk of companies that's driving the returns in the index. Is there anything you can do about that?
Well, you can avoid market capitalisation weighting of the index, which is basically the larger the company, the more shares you buy, and that means to put a point on it, is you catch every bubble going. Right? If you'd invested in the FTSE 100, like you say, in the run-up to 2000, you bought those 10 stocks, those 10 TMT stocks, as they got bigger and bigger. You did the same thing in 2007, 2008. You bought the financials, and they got bigger and bigger and bigger. Now, today, you're looking at, actually, it's still the oil companies, Royal Dutch Shell and BP. Not sure people are too worried about a bubble growing in oil. But if you look at the FTSE 100, about 20% of your money is just in oil stocks. So being aware of what you're buying and trying to understand that just buying an index doesn't necessarily mean you're diversified is one way to approach that. And fortunately, because the financial world's never slow to catch up on these things, there are lots and lots and lots of products available. You can have an equally weighted index, you can have it weighted by dividends, you can have it weighted by the value of the companies, you can have it weighted by almost any metric you care to name for a reasonable fee. You just need to get comfortable with what that weighting is and why you've done it.
And choosing an active fund manager, you might think, okay, well, that solves the problem because I've got an active fund manager there picking stocks and watching out for this kind of thing. But that's not necessarily going to solve the problem for you, is it? Because there's an awful lot of active fund managers out there who are paying quite a lot of attention to their benchmark, which will be the index, and they don't want to stray too far from it, so they will actually tend to hold quite a lot of those companies in large amounts, even if they don't think they're that good.
Yeah, so the way we think of it is it's always the tail you've got to watch out for with these fund managers, right? And that's because there are people who say, I've got a brilliant idea and I'm really overweight a specific stock. And you go, how much is it in your portfolio? And they go, it's 10% of the portfolio. You go, wow, that's really punchy. Then if you look at the rest of the portfolio and it's bang in line with the index, guess what? You're probably going to perform like the index. So finding active managers who genuinely have either really high conviction, which can go right or wrong, but at least you've kind of decided to go with someone who's making big active calls. So you could go find someone with high conviction, or find someone who's playing in an area that's not looked at very much. UK microcap, US microcap, these tiny little companies, they're areas where actually managers have an advantage. There's no one looking at them. They're probably investing in companies you'll never have heard of, but they do get to generate some pretty outsized returns.
And also researching companies that you just, unless you're in the industry, and maybe even if you are in the industry, you've just not got time to do yourself. So that's where they really earn their money, looking at the fact that there is, in terms of the US micros, there's another Apple out there somewhere. And one fund manager, at least, will spot that, and good luck to the investors who, get on at ground floor. But by the same token, of course, that comes back to your general attitude, what sort of return you're after. and of course your attitude to risk, because inevitably with the smaller companies you're going towards slightly higher risk.
And that's a more volatile environment to be fishing in, isn't it? But one of the benefits of that can be that if you do see the big correction, is that those kind of companies tend to get sideswipes by what's gone on further up the scale that may not even really have anything to do with them, and actually they tend to get hit harder initially, don't they? Because everybody dumps the riskiest things that they have, and so they get hammered, and that can provide a bit of an opportunity, can't it?
It can, and it's yet another one of the difficulties of investing in smaller companies, because one of the key metrics you might look at, for example, for larger companies is their sustainability and ability to pay dividends, whereas you'd probably expect with smaller companies that any profit they make is ploughed back into the business as opposed to paid as a dividend. So immediately one of your key metrics is sidelined. So that's when you start need to looking at, be looking at track records and real profitability, what their USP is in their industry and that kind of thing.
And just finally on that, Ben, as well, is there another key thing to bring in there, which is companies that tend to survive these things? Debt is an issue, isn't it? And that can be the real killer for them.
Yeah, and I think debt's going to be one that's going to come back on to a lot of active fund managers' radars quite soon, as you see interest rates rise around the world. Because, there will be a lot of analysts out there, my age or so, who've never seen an interest rate rise. So they've been analysing companies for near on a decade now, and they feel that they're pretty good at it, pretty experienced, and they know that the price to book or the cash flow or the earnings, whatever, but they've never really seen a company deal with cost of debt increasing. And I think that is incredibly challenging for people to cope with. So yes, you need companies that are experienced with dealing with it, but you also need analysts and fund managers who are experienced in looking at companies in that way.
Thank you very much. That's all we've got time for. Ben, thank you. Richard, thank you.
Pleasure.
Thank you very much for watching. Join us next time. Goodbye.